We all know that Rome was not built in a day, but it also didn't fall in a day either. The truth is, the collapse of empires is rarely swift. In fact, most often in world history, the collapse of a global power takes at minimum years, most often decades, and sometimes, as in the case of Rome, centuries. But almost always, the fall of a great power is triggered by a financial crisis, specifically a sovereign debt crisis, when the out-of-control spending must continue to increase to pay for the over-indebtedness. And the over-indebtedness must then continue to increase to fund the out-of-control spending. And unfortunately, this is the exact position that the United States finds itself in today. Let's find out why. Bipartisanpolicy.org has a nice little debt tracker. The black line showing the deficit for 2019. As expected, a massive increase in the deficit for 2020 with the red line. The yellow line for 2021 was also a large deficit, though a little bit smaller than 2020. And after this, most people expected things to just go back to normal. And in the first half of 2022, many people thought that they were going to be right about that. The deficit in the first half of the year for 2022, which is the light blue line, was right on track with 2019 numbers, and even into the second half of the year looked like it might even be better than 2019. But direction and consistency matter more than place. And so if you're stronger than me, but you never work out, and I'm weaker than you, but I work out every single day, your place doesn't matter as much as my consistency and my direction, because you're staying the same and I'm getting stronger. Similarly, when you look at the trajectory of 2022, the deficit started to increase very rapidly, and by the end of the year, overtook 2019, leading us into the green line, which is as of yet incomplete, showing a quickly increasing deficit yet again. By all measures, these things should have been getting better by now. They shouldn't be getting worse in 2023, especially after we had a year where it looked like things were going to get better. But what exactly is the deficit that we're looking at here, just in case you aren't aware? This is simply the difference between how much the government gets in taxes and how much money the government spends. So if you make 100 grand in a year and you spend 200 grand, you have a deficit of $100,000. So the question is, where are they getting this money from that they're spending? And the answer is they're doing the same thing that you would have to do if you spent more than you made. They're borrowing it. So anytime you hear of the government's budget deficit, just think this is how much the government is borrowing in order to spend all the money that it's spending past what it's taking in from taxes. It's also important to note that this budget deficit is different than the trade deficit. The trade deficit is just the difference in money that we spend on stuff from other countries versus the money we get from other countries by selling our stuff to them. In this video, the trade deficit doesn't matter at all. We're specifically looking at the budget deficit and the debt and the interest rates and so on. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, I Trust Capital is still going strong because they do things the right way. You own your assets assets there. Your assets are always held off balance sheet, and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. And they are straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. Since we know that the deficit is getting much worse right now at a time where it should not be, and that we know that the deficit is how much the government is borrowing in excess of the taxes it's taking, we also know that this means the national debt is starting to increase rapidly, and it currently stands at $32.5 trillion. To put this number in perspective, the national debt has tripled since 2008. So it took the United States' entire history to get to $10 trillion in 2008, so 270 something years. It took less than 10 years to add another $10 trillion to the national debt from 2008 to 2017, and only 6 years to add more than another $10 trillion after that. To put it lightly, the national debt is increasing exponentially. But the total debt load, this $32 trillion, or in the future, 40 trillion, whatever it ends up being, that's not even the problem here. Because hypothetically, if this was all 100-year debt and they had to pay off this $32 trillion over the next 100 years, that actually wouldn't be that big of an issue. So we have to dive into the details of this load of debt to see where the issue lies. In this year's In Gold We Trust report from Incrementum, we see a chart of a few different nations and their breakdown of their national debt. For each nation, the first dark blue line represents debt that will mature within the next 2 years. The gold bar represents debt that matures within 2 to 5 years. The light blue line is 5 to 10 year debt. The green line is 10 to 30 year debt. Then the purple line is anything over 30 years. You'll notice for the USA, there is no purple debt. The whole of the national debt matures in under 30 years. But the real problem shows up in that massive dark blue line that reaches the top of the chart. Looking at the x-axis, we can see that this chunk of the US debt represents almost half of the entire national debt. This means that within the next 2 years, 1/2 of that $32 trillion will come due. Now, in a moment, we're going to see why interest rates are going to be headed much higher soon. But for the moment, let's just assume interest rates stay where they're at. The 1-year treasury is right around 5.3%, the 2-year at 4.7%, the 10-year at 3.8%, the 20 a little over 4%, and the 30 at 3.9%. So over the next 2 years, half of the national debt is maturing. That means the government has to pay that money back. But we know because of the deficit the government is running, they're not bringing in enough money from taxes in order to do that. So they pay off the old debt by borrowing new debt. This is known as refinancing. It's the exact same thing that happens if you refinance your house. Let's say you bought a house years ago with a 5% mortgage, and then in 2020, you refinanced at 3%. You borrowed a new amount of debt to pay off the old loan, and now you owe the same amount of money, just with a different interest rate. Problem is the government's doing this backwards because the government has borrowed $20 trillion since 2008. And you can see that interest rates since 2008, for the most part, have been lower and sometimes much lower than they are right now. Which means over the next 2 years, as they have to pay back $16 trillion worth of debt, and they have to borrow $16 trillion more in order to do that, they're increasing their interest rate on that debt load. Hypothetically, if that refinancing can succeed at an average rate of 4.4%, then the interest on the national debt would more than double to become $1.2 trillion by 2025. If we take a look at this chart from the Peter G. Peterson Foundation, we can see the difference in the government's spending from 2022 to 2023. Thankfully, there were some areas that decreased. We saw an 11% decrease in income security spending and a 2% decrease in health. However, we have seen a 40% increase in the net interest expense category. And that's just so far. But as we already saw, over the next couple of years, we are to see a massive increase even from here. Just to put that $1.2 trillion into perspective, that's almost twice of what the government spends on Medicare. more than double what it spends on Medicaid, and about equal to what the government spent on Social Security in 2022. In fact, 1.2 trillion is getting dangerously close to the entire discretionary budget of the US. Right now, when we look at federal government spending, we usually break it down into two categories: mandatory spending and discretionary spending. Discretionary is things like the military, transportation, science, environment, education, and others. Mandatory spending is things like Medicare, Medicaid, Social Security, and other spending like that. But within the next 2 years, the interest on the debt by itself will be so large that people look at it as its own category, because the discretionary spending, let's be honest, is not going away. And the mandatory spending, let's be honest, is definitely not going away. But the interest on the debt is going to increase no matter what, which means the deficit must increase as well. Because if your spending on all your categories will stay the same or go up, and then you have another category, the interest on your debt, that's increasing extremely rapidly, and you are already not bringing in enough taxes to fund all that spending, you just have to borrow more in order to spend on everything still, which means that deficit will reach record numbers yet again. A deficit, which is by definition borrowing more, again at the higher interest rates, and now you can see why this is called a sovereign debt crisis. You have out of control spending that is funded by borrowing and borrowing and borrowing, but the cost of that debt forces you to have to spend even more and then borrow even more as a result. By the way, guys, I'm going to be speaking at the Stock Pulse Silver Symposium about the history and future of sound money. It's in Las Vegas from September 29th through October 1st. There's going to be a ton of other great speakers there. There are going to be plenty of opportunities for us to do meet and greet, hang out, get some drinks together. I'd love to meet you there. And everybody who shows up is going to get 1 ounce of silver as well, a 1 ounce silver coin. So I'd love to see you there. There's a discount link, 10% off in the description below. So sign up there, get that discount, and tickets are running out, so sign up soon. A big question right now though is, why are rates not yet up right now from this? Yes, interest rates were increasing all during 2021 and 2022, but ever since October of 2022, interest rates have flatlined. It's very clear to see the fiscal situation the United States is in. The spending can't slow down, the borrowing can't slow down, the deficit can't slow down, the interest rate is only going to go up, which means the deficit is going to increase, which means more borrowing, more supply of debt, higher interest rates. But why are they not responding yet? This is where the reverse repo facility comes in. The reverse repo facility is an account at the Federal Reserve that currently has $1.7 trillion in it. When all the spending happened during 2020 and 2021, there was a lot of cash injected into the banking system. In order to prevent banks from using this cash to buy US government debt and maybe push interest rates negative, the Fed opened up the reverse repo facility. This allowed banks somewhere to put the cash and earn a very small interest rate. But ever since April 2021, the Federal Reserve has slowly increased the interest rate they pay on cash inside the reverse repo facility. Once it became clear that inflation was embedded, the Federal Reserve really did not want that cash flooding back out into the market and causing any sort of stimulus that may have made inflation more sticky. So the Federal Reserve wanted banks to keep all that cash inside the reverse repo facility, so they started paying them a lot to keep it in there. But over the last couple of months, cash has started to drain out of the reverse repo facility for the first time. This is because the amount the Federal Reserve pays on cash inside the reverse repo facility is 5.05%. But banks can now get a 1-year US Treasury for 5.3%, or they could even get a 6-month for 5.48%. Basically, government borrowing has gotten so expensive that it is now incentivizing anyone with cash to loan to the government now again, instead of keeping that money here in the reverse repo facility. With $1.7 $1.7 trillion left in the reverse repo facility. This means that the United States government has about $1.7 trillion more they can borrow from here without interest rates moving meaningfully up from where they are right now. If the government tries to borrow a ton more and there's not enough demand for that debt, interest rates get pushed up from that. Well, that means more money is attracted to come out of the reverse repo facility and be lent to the government instead. The monthly budget deficit that the United States government is running is significant in 2023, which means at the current rate that the government is borrowing more money right now, we have somewhere around 1 year before this reverse repo facility is fully drained. At that point, we will start to see interest rates on government borrowing start to move significantly higher because there won't be that slush fund left in the reverse repo facility of cash looking for yield. It will have already all gone out and gotten lent to the government. So at that point, when the government has to borrow more from there, they'll have to offer a higher and higher interest rate in order to attract more cash from the banking system. And so far, we're just looking 1 to 2 years ahead. In the next year, the reverse repo facility will be drained, and within the next 2 years, half of the government's debt will be refinanced. The interest expenses alone will be at least $1.2 trillion. And even without any increased spending in any of the other categories, or without any increase in interest rates from there, which we know is inevitable, that line item on the budget, the interest expense, will continue to move higher from there, which means it's only a matter of time before the federal government simply won't be able to afford that anymore. Because the only way they're paying that debt is by borrowing new debt. That requires somebody there to lend you those dollars, which means the government either has to offer a higher interest rate, which they may not be able to afford, or there's just no borrowers, or there's just no lenders, which means they can't pay their bills. So at that point then, what happens? At that point, you get one of two things. You either get a return of quantitative easing or you get full-blown yield curve control. Quantitative easing is a fancy word for debt monetization, and that's where the Federal Reserve prints money to loan to the US government. Their balance sheet represents all of the debt that they own, and when it's moving up, that means they're making more loans, and when it's moving down, that means they are letting some of those loans get paid off. QE means that the Federal Reserve prints a specific number of dollars to lend to the United States government to make funding their expenses a little bit easier. Yield curve control, on the other hand, is qualitatively different. Yield curve control doesn't say, hey, we're gonna buy a specific number of bonds. Yield curve control says we're gonna set a specific interest rate on those bonds, meaning we'll buy any amount necessary in order to peg that rate where we want it. So if the 10-year treasury gets up to, let's say, 8% before the government can't afford it anymore, then maybe the Fed comes in and says that the 10-year treasury will now be 2%. Which means they buy any and all of those 10-year bonds necessary in order to keep those rates pegged lower. It's worth mentioning that Powell has recently seemingly switched this narrative, saying that this would never happen. And it may be that central banks like the Fed have realized they've funded too much government spending in the past and are trying to make up for their mistakes. If the Fed will not step in to save the government once the federal government is insolvent, my expectation would simply be a rewriting of the Federal Reserve Act by Congress in order to give them a new mandate, forcing the Federal Reserve to comply, essentially just becoming the money printer for the government. Alternatively, they could fold the Federal Reserve underneath the Treasury and take direct control. Either way, though, I do not anticipate an actual default where the government cannot pay its bills. At the end of the day, the Federal Reserve will either voluntarily perform QE or yield curve control, or they will be forced to do so by the government. So what does this mean for deflation, for inflation, for your investments, and can this be stopped? First of all, I'd like to mention that these are exactly the things that I teach my members of Heresy Financial University to be able to protect themselves against. So you don't have to be vulnerable to deflationary debt spirals, to hyperinflation. You're properly hedged so that you're exposed to the market, but you don't have to worry about the crashes, using advanced investing strategies in order to increase your returns while decreasing your risk. If you're interested in joining, I've got the details linked in the description below. So first, it's pretty clear to me that we are in for very low inflation at the least, but most likely deflation in the short term over the next 1 to 2 years. As government borrowing costs continue to increase and the government continues to borrow more and more as that deficit increases, we experience crowding out. So what is crowding out? Basically, I'm a saver, I'm a lender, and I have two borrowers in front of me that are both looking to borrow at 5%. One is an individual, let's say a third in there. Let's say there's another that's a corporation and another that is the US government. And they all can afford a 5% loan. And I can only lend my money to one of them. Who am I gonna choose? Well, I'm gonna choose the US government because I have the greatest likelihood of getting that money back. An individual or a corporation may default or file bankruptcy, and I may not be able to get my money back, which means that for the individual or the corporation to get financing, they have to borrow at even higher rates, many of which just cannot afford it at the interest rates they're at right now. The higher interest rates on government borrowing are, the more this crowding out effect takes place. Just sit there and close your eyes and think, who in their right mind would invest in the S&P 500 if the government was borrowing at 20%? Nobody. Every single person would lend all of their money to the US government. They'd sell all their stocks, they'd sell their other investments, and get the guaranteed 20% from the government. This would cause massive deflation, deflationary death spiral, defaults. Financing would be available for almost no one except the government. And so to the extent that government borrowing increases in an economy, it crowds out private sector financing and makes economic progress that much harder. But this is only going to last a short amount of time because at some point the government won't be able to afford that anymore and the Fed will come in to print the difference. Once that flip switches, or once that switch flips, then we get inflation because suddenly the money supply starts to rapidly expand again because every dollar the government spends in excess of taxes is simply then being printed into existence. That's not happening right now. That was happening in 2020. It was happening in 2021. It's not happening right now. Short-term deflation, long-term inflation. To make matters worse, the Federal Reserve will continue to try and fight inflation. They'll continue to try and raise rates for everybody else to squeeze spending, meanwhile financing all the government spending, which means the government will be massively and rapidly increasing the amount of currency in circulation, while at the same time it will be hard for individuals and corporations to get the financing they need. So yes, short term, we do have a period of deflation ahead of us, but the long-term view for the next decade or maybe even 2 decades or longer is going to be inflationary. Now, I want to be very clear that none of this is inevitable from the standpoint of it has to happen. It's not like the cake is baked already and that just mathematically it has to happen this way. I've detailed in past videos very clear outlines of cuts that the government could make to spending that would not leave anybody who actually needs the money hanging high and dry, move major spending programs towards needs-based instead of things like age-based, stop policing the entire world, and almost completely get out of things like education and healthcare. If the government were to just do a couple of these big things, it would move the needle significantly enough that we could actually start heading back in the right direction. So collapse or end or failure or even a sovereign debt crisis is not baked into the cake yet. It's just that it's political suicide for anybody who has the ability to actually make these decisions. And so it's almost certain that it won't happen. So we're headed this direction because the people who have the power to do anything about it are the ones that directly benefit from continuing to go in that direction. So it is stoppable, it's just politically unpopular. And that's why I'm more concerned with understanding how it works, looking at where we are probably headed, and then doing something about that. And if you'd like to join me, Heresy Financial University, linked in the description below. As always, thanks so much for watching. Have a great day.